what we're going to be going through here is governmental accounting for a capital project. We're going to be setting up the funding for this project. We're going to be issuing purchase orders and contracts through the Capital Projects Fund, and we're going to be financing this project through a cash transfer and the bond issue. So when we're talking about governmental accounting, we have to be concerned with our governmental funds here, and also our accounting control groups here. So for our example here, we're going to have this Capital Projects Fund here for our funding of this project. We're going to be looking at that here. And then along with our governmental funding here, we're going to have this debt service fund. This is where we're going to actually be collecting the monies and paying the debt through the debt service fund here. And then in our accounting control groups, while you would have your general fixed assets here, that would just be a listing of your fixed assets. And then what we're going to be looking at here is our general long-term obligations, and that would include some long-term debt, and that's what we're going to be looking at with our bond issue here. And what you'd be doing here in those accounting, in this general long-term obligations or long-term debt here, you'd really be keeping track of the unmatured principal here. Okay, so for our example here, the city, this is a government body here, is to construct a new roadway that's estimated to cost $400,000, and it's going to be financed here by a transfer from the general fund here of $40,000 to the Capital Projects Fund, and then secondly here, they're going to issue a serial bond here for $360,000, and it's going to be a 4-year bond, have a 10% interest rate on it, and it's going to be issued at its face value here. And what they're going to do, they're going to levy a special assessment to pay for this serial bond here. So total cost is estimated to be $400,000. They're going to finance $40,000 of the $400,000 by a transfer from the general fund to the Capital Projects Fund, and then the remaining $360,000 is going to be by issuing a serial bond here. Okay, so this is what we have to do for our recordings here. So first for our Capital Projects Fund. Now this is where we're going to account for the resources used in the construction here. So first for our transfer here, we're going to have our general fund here, and I've got everything laid out in T account form here. So what you have to do is you have to know what these account names are here when you're talking about governmental accounting. Much of it's your journal entries here and any balances, you have to be familiar with the names that we're using here. So for our general fund, for that transfer of the cash here to our Capital Projects Fund. So we would take our cash account, again in our general fund here, and we're going to transfer it out. We're going to credit cash here for $40,000, and then we're going to go over to our other financing uses control account here, where we're going to make that use that cash here and transfer it to our capital projects. So we're going to debit our other financing uses control account here for $40,000 for the transfer out. Okay, and now in our Capital Projects Fund, we'd make these recordings here. So we've really got two things going on here for our capital project funding. This transfer of cash here between the funds and also issuing that bond. So going to our Capital Projects Fund, for our cash account here, we would debit that here for $40,000 for the transfer in. Now you see in our general fund, we credited or reduced our cash here by $40,000. So in our Capital Projects Fund here, we would debit or increase our cash here by $40,000. So it's simply an exchange of cash. Now for our Capital Projects Fund, where we're gonna get set up our account here, other financing sources here, and that's going to be for the transfer of that cash in plus our band. So remember, our cash came in here, debited it for $40,000 here. It came in from the general fund here. So the credit is going to go to other financing sources. Credit it for the $40,000 of the cash that was transferred. So in our general fund, we had a debit here, other financing uses control account here for $40,000. So in our capital projects, other financing sources, it's a source here coming from the general fund. Credit it for $40,000. And then the other item that's going to happen here, other funding is going to be through this bond that's going to be issued here, this serial bond. So for our cash account, in our Capital Projects Fund, debited here for $360,000, and then other financing sources here, we're going to credit it here for $360,000 for that bond that's going to be issued. And then for this bond here, the principal and the interest payments are going to be made through the debt service fund, and we'll look at that at the end here. Okay, so we've taken care of our capital project funding here and making our cash transfer from the general fund to our capital projects fund, and also the issuing of that bond here. Okay, so next let's go up here. Now let's look at our capital projects fund here for issuing purchase orders and our contracts and receiving the invoices on these purchase orders and contracts, and also the approval of those POs here and contracts, approval of the invoices here. So this is what you're basically going to have to do here. And I'm just showing everything. You know, you'd have many purchase orders coming through, and you might have several contracts on this project here, but I'm just lumping everything together here. The difference we're going to be looking at is our purchase orders and our contracts here. So when you're talking about governmental accounting, you're going to set up, in this case, we're going to set up this encumbrances control account here. And then along with that, we're going to have a fund balance reserve for these encumbrances. And then tied into this encumbrance system here, this is where we're going to actually get into our payables here on those purchase orders here and those contracts. And then we're going to be recognizing our expenses here. And everything is going on in our capital projects fund here for issuing the POs, our contracts, and receiving any of those POs and our contracts. So let's start out, and then of course our cash account here. We're going to be looking at that here. Okay, so those are the accounts that we have to deal with here. So let's start out with the case here. We're going to have $80,000 worth of POs that were they're estimated expenditures here in our encumbrance system. This is where you're going to put in the estimated amount. So we're going to have $80,000 worth of POs that are going to be issued here for our example. So we're going to debit our encumbrances control here for $80,000. Now remember, this encumbrances control here is a contra account, and I'm not showing the contra account that it would be to is the unreserved fund balance here. I'm not showing that in T accounts here, but this is what you're going to do here. You have to set up this encumbrance system. When you're using the encumbrance system, you have to set up this encumbrances here for, again, and it'd be a contra account against the unreserved fund balance. Okay, so back to our issuing $80,000 worth of POs here. Encumbrances debited for $80,000, and then we go to the fund balance reserved. That's our set aside here. We would credit that here for $80,000 for those POs. Now remember, this is the original estimated amount. And then along with our POs, we can also set up our contracts here under our encumbrances system. So let's just say our contracts were estimated those to be $320,000. So debit our encumbrances for $320,000, and then go over to our fund balance reserve, credit that here for $320,000. Remember, that's our original estimate. Everything you put your estimated amounts, your original estimated amounts in your encumbrances here, and also your fund balance reserve for the encumbrances. Okay, so now let's go down here, and let's say we actually received those POs here. The work's been complete here on our POs, and also work's complete here on our contract. So what we're going to do is we're going to look at our payables. We're going to set up our payables here, our liability account. We're going to, in this case, we're going to we use the actual billed amount, of course, here in governmental accounting. In your payables, you're going to use the actual amount that you're billed versus your encumbrance system where you use the estimated amount and you stick with the estimated amount. So going back to our POs here, our actual billed amount, we're getting in $74,000 here. And then for our contract, the actual billed amount here is $325,000. So we're going to credit our payables here for those actual amounts here. $74,000, $325,000. So we go over in our expenditures here under our capital projects fund again here. We would debit it here for $399,000. The invoiced amount, whatever our actual billed or invoiced amount, that's what we're going to recognize as expenditures. That's our total amount here. Okay, so that would be setting up our payables or our liability here. Now, going back to our encumbrances controls here. Now, this is where we're going to remove. We're going to have to reverse these encumbrances here upon receipt of those that POs and our contracts here, because we no longer have an encumbrance on them, and we're going to reverse them at the original estimates here. So for our POs, we're going to credit encumbrances here for $80,000, and our contract, we're going to also credit that here for $320,000. And then same thing for our fund balance reserve. We're going to reverse that out. We no longer have a reserve on it because we received those POs and they're going in the contract and they're going in as a liability or in our payables here. So debit that here for $80,000, and also that's for POs, and also debit for our contracts here for those $320,000. So we no longer have any our encumbrances here are sitting at 0, and our fund balance reserve is sitting at 0. Just remember, use the original estimate here when you're reversing those amounts versus the actual amount. So yeah, again, just remember here, if I didn't mention it, those POs, the $80,000 here was what we estimate. Our actual receipt here, or actual billed amount here, was $74,000 versus our contract here we had estimated at $320,000, but the actual billed amount that comes in for our contracts is $325,000. Okay, so they're setting up our payables here and recognizing our expenditures. Again, remember our expenditures here are the actual billed amounts here between our POs and our contract. Now, this is where we approve our invoices for payment here, and this is we've got one little detail to be concerned about here. So for our POs, again, we're going to debit it or remove our payables here by $74,000, the actual billed amount, and same for our contracts. They've been approved here. We're going to remove those at the actual billed amount here of $325,000. Now, normally here you're going to take, when your payables, you're going to debit your payables, and you're going to go and you're going to credit or reduce your cash because you're going to pay for these. In this case, our vouchers here or our POs here in our contract. But this is the key here. This is the case here where the invoice is going to be approved for payment here, a total of $369,000. Now, normally municipalities or governmental bodies are going to withhold on these capital projects. They might withhold some amount for final approval, for final checking of the project. So in this case, they're going to withhold $30,000 worth of this $325,000 contracts that were issued. Now, they removed them off our payables here by $325,000, or removed off our liabilities here by $325,000, but we're going to credit it back here for that retained amount here. We're retaining $30,000. So this is how we get our cash amount here on our cash that's going to be paid out at $369,000. So we have a total amount here, actual billed amount here of $399,000, the $74,000 plus $325,000, but we have to credit back here for that $30,000 that's being held here, $30,000 worth being held here for final approval of the contract here. So there's where we're going to get our $369,000. So just remember, any holdbacks here on contracts here for final approval, you take, and you could have just taken the net amount here between those contracts here, the $325,000 less any holdbacks, but just to show what's going on and understand what's going on here, you mark them off here, or you reduce your payables by the total actual amount billed, and then you would credit back any amount that's being retained. But nonetheless, you have to net out your debits with your credits here to determine what your actual cash outflow would be here. So you can see our cash account here, just going back to it. We had that transfer in here, debit for the $40,000 transferred from the general fund to the capital projects fund, and then of course we had the bond issue here, debited that here for $360,000. We had a total of that would be a total of $400,000 for this project, but now we're going to use up $369,000 of the $400,000 here for those POs and contracts, and the $369,000 wouldn't include that $30,000 that's being withheld here. But you can see if that gets approved here, what does that bring up? $399,000 here total cash that would be going out here versus the $400,000 coming in. So pretty good cash flow here based on those original estimates. Okay, so now let's go down and so we've taken care of our issuing our POs, our contracts here, and receiving any invoices on those POs and contracts. Just remember here, use the encumbrance system here on those capital projects when you're talking about a governmental accounting, where you have to set up an encumbrance here based on the original estimate price that you have on your purchase orders and your contracts here. And then again, you remove, once you receive those POs and contracts, or contracts are complete, the POs are received, then you set up your payable here, and once they're approved, reduce your payable. But when you set up your payable, do it at the actual billed amount here. So that's really what you're doing here with those governmental accounting. And then once everything gets approved, just to go back to it, then you can reduce your cash or pay your cash out. Okay, so let's go down here now. Now we're going to be looking at the debt service fund, where these property owners are going to make payments to the debt service fund, and in turn the debt service fund is going to make payments that are required by the required here for their serial bonds, or to the holders of their serial bonds. Now remember, the debt service fund, that's going to accumulate the dollars here to pay debt. We're also going to pay debt out of it, and it's going to be closely related to the general long-term debt account group. And that general long-term debt account group, that's where we're going to record the unmatured principal for our long-term debt in this case, or it could be a long-term obligation, but we're looking at long-term debt. Okay, so the entries for recording this special assessment, along with the payments that are made to the debt service fund to pay the serial bonds, that interest plus principal, are going to be showing next, along with this general long-term debt account group, the entries we'd have to make into that. Move up to our debt service fund. Again, this is where we're going to be looking at the property owners are going to make payments to the debt service fund, and the debt service fund in turn is going to make payments required by the serial bond. So again, our debt service fund, this is where we're going to accumulate dollars to pay off our debt, and we're also going to be paying our debt through the debt service fund here. And we're going to be looking at the special assessment payments that are going to have to be made here to the debt service fund. The special assessment payments are being made by the property owners here. Okay, and we're just going to look at the first year here. So what do we have to do here in our debt service fund? What we're going to I'm showing it again in T account form. We're going to be looking at our receivables here, that special assessment, and then we're going to have to, what we're going to be looking at is recognizing our revenues here on that special assessment. And then along with that here, we're going to be looking at, based on our receivables, we're going to have receivables going to be cash that would be coming in here. And then, well, it's going to be shown here in our cash account. So we're going to be looking at our cash coming in, and then for our cash coming in, we're going to be paying out that cash here. We're going to be looking at the cash going out as the expenditures. Okay, so let's start with our debt service fund here. Let's look at our receivables. We have to determine, we have to break those apart between the current receivable here and the receivable that's deferred. So when we're talking about current, we're really talking about this first year that we're looking at here. So for our receivables, again, under a special assessment, debit that here for $90,000. Now that's at the issue date here, that serial bond here. And along with the debit of $90,000, then we're going to recognize that as revenues here as a special assessment. We're going to credit that here for $90,000. And what we're really doing here when you're dealing with these governmental funds, you're looking at modified accrual accounting. That's where, again, governmental accounting, modified accrual here. This is where you cannot accrue any revenue unless it's available and measurable. So what we're accruing here, we're saying is available and measurable. Okay, so we've taken care of our current receivable here, debited it for $90,000, and recognized it as revenue as a special assessment here in our debt service fund here for $90,000. Now we have to set up our deferred. This is the remainder of that receivable here. Receivable, title it receivable deferred here, again for our special assessments, and that we would debit for $270,000. We have the total here of $360,000, and it's for 4 years, so we recognize $90,000 here for the first year. That would be the current portion here, $90,000. So the remaining $90,000 here from $360,000 is going to give us remaining receivable here as a deferred here amount of $270,000. Now that's at the issue date here, 1/1. again for the first year here. Then we would go over and we're going to credit the deferred revenues here, special assessment in our debt service fund here, credit it for $270,000. So we've recorded our receivables here. Just remember, you have to break it apart between the current portion here and the deferred portion, since we're dealing with some long-term debt here. Okay, so we've taken care of our receivable here at the issue date. No cash involved at that point. Okay, so our cash we collected, remember, in the capital projects fund, we collected $360,000 here. So now comes that first payment date here. Let's just say that's 6/30, semi-annual payments. So we're looking at semi-annual payments here in 6/30, mid-year here, and then 12/31, the end year here. So what are we going to recognize as revenues here? Receivables. Well, we're going to take, for that first payment, we're going to credit or reduce our receivable current amount here by $45,000. That is that semi-annual payment here. $90,000 for the year here. The principal amount divided by 2 semi-annual payments is going to give you $45,000. Okay, so we credit, reduced our receivables here by $45,000, and then in our revenues, again, special assessment, we're going to credit that here for $18,000 for that interest expense. We had that total $360,000 outstanding here for that 6-month period, times half, a 5% interest rate, half of the 10% here is going to give us $18,000 of revenues. We're going to be receiving those revenues here from the taxpayers that are being property tax owners that are being billed here for that new construction of the road here. So credit it for $18,000. Then we have to move up to our cash account for the debt service fund. Again, everything we're doing here is in the debt service fund. So looking at the amount coming in, that would be the $63,000. That was the $45,000 reduction here in our receivable credit to our receivable here for the current special assessment here, plus the credit here for that interest, that first interest payment, $18,000. So cash coming in, $63,000. We look at it in those terms based on our modified accrual accounting here and what the property owners would be paying in here to the city. And now we have to pay for that bond, that serial bond here for that first payment. So we have the debit here in our cash account, $63,000. So we credit it out here, our cash for $63,000, and then the debit would go to our expenditures here, debt service fund, for our label principal and interest here, debited for $63,000. So that's at our 6/30 date here. Remember, the $63,000 here is that $45,000 reduction here in our receivable, our current amount, our reduction here, plus the $18,000 here that we have for the interest on that serial bond. So that is where we're getting our expenditures and our cash. Cash coming in, $63,000, and then cash going out here, and we're recognizing it as an expenditure here of $63,000. Okay, so we've taken care of that first payment here at 6/30. Same thing for the next payment here, end of the year here for that second payment here. Again, credit, reduce your receivable by $45,000, and then your revenues. This would be the interest payment that would be paid here by the property owners here. That would be, let's say, $315,000 left. We had a reduction here of $45,000 from the $360,000. We're left with $315,000 times 5% is going to give us an interest. It's going to be an interest payment, the semi-annual interest payment here, $15,750. So credit your revenues account here, special assessments for $15,750, and then go up to your cash account here in your debt service fund. Again, everything's done here. You would debit that here for $60,750. $45,000 reduction here in your receivables current, plus your revenues for the interest here, $15,750 for total here of $60,750. So there, increase your cash for that amount, then that would be the cash, the revenues coming in, or the cash coming in here from the property owners here, and then credit it out here for $60,750 for what you're going to pay on that serial bond here. So payments made to the serial bond or the bondholders here. Debit your expenditures here for the principal interest, again, for $60,750, so $1231. So you see what's going on here. We first had to set up our receivables, break it apart here between the current and the deferred portion, and then we looked at that first year here, what we would recognize as a receivable here for the two semi-annual interest payments. We reduced our receivable current portion by that amount, and then along with that, we had to recognize revenues for the monies coming in here based on the interest payment that we're going to need here for paying off that serial bond for the first two payments here, mid-year and end of the year here. And then when we got that money, both for, we recognize as our reduction in our receivables here, plus our revenues here for the interest payments, we recognize that as cash coming in here, and then we had to pay out the cash to the serial bond holders here. So we paid out the cash here, and then we recognize it as expenditures here, both what we reduced as our receivable here, the current portion, plus the interest. Here the interest was interest payments coming in. Here it would include the interest payments coming out. So there we would have debited, again, our expenditures for principal and interest. Again, this is everything's going on here in our debt service fund. Okay, so now let's go down and let's look at our general long-term debt account group. This is where we're going to record the unmatured principal and long-term debt. Again, remember the bond was issued here for $360,000, 4-year bond, had 10% interest rate, and serial bonds would be issued at their face value here. So this is where you have, what you have to do in your general long-term debt account group. This is where you account for the unmatured principal and obligation or debt. In this case, it's debt. So you want to look at your title here. This is what you have to do. You have to say the amount to be provided for these special assessments. So and then what you would do, well, let's look at that. Amount to be provided for special assessments. And then you're going to have, as your liability account, you're going to have your serial bonds payable for the special assessment. So this is where you get your bonds payable here. Again, that $360,000 bond that was issued here, debit your amount to be provided here, $360,000, and that's on the issue date here. And then in your serial bonds payable for the special assessment, credit that here for $360,000. So that's the serial bonds that are payable. Now, we come down here on each of those payment dates, 6/30 and 12/31. We reduce the amount to be provided because it's going to be provided. We're going to be able to reduce it here by the $90,000 principal per year here, two semi-annual payments for $45,000 would be the semi-annual here. Reduce or credit your amount to be provided here by $45,000, and then your debit is going to go to your serial bonds here because you're going to reduce your requirement here on your serial bonds by $45,000. So you can see here for each of those payments here. So you can see what's going on here in your general long-term debt group here. The principal, we're keeping track of that principal and we're reducing it for the principal that would be paid here on each of those semi-annual payment dates that we have here. So that's what's going on in your general long-term debt account group. Accounts for the unmatured principal of the obligation, and we were reducing that unmatured amount here. We'd be keeping track of the unmatured amount here based on our reductions. Okay, so you see what's going on here in your general long-term debt group.